Most people watching the Iraqi dinar are waiting for a headline. But currencies don't move on headlines. They move on pressure, discipline, and decisions that often go unnoticed. As we move deeper into January 2026, Iraq isn't making bold promises or dramatic announcements. Instead, we're seeing quiet signals across exchange rates, banking policy, and fiscal management. And for serious observers, those quiet signals matter far more than speculation. Let's begin with the clearest anchor point, the market rate. On January 13, 2026, in Baghdad, the US dollar was recorded at 147,200 Iraqi dinars per $100. Now, that number matters for two reasons. First, it confirms that the market is still operating within a managed and recognizable range. We're not looking at runaway volatility, and that's important. Stable ranges usually reflect active control, consistent dollar supply management, and a market that's functioning, even if it's not perfect. Second, the level itself also reminds us that the dinar story in 2026 is not about sudden strength, it's about pressure management. When you see a rate like this, the main question isn't, will it jump tomorrow? The main question is, what conditions keep it stable and what conditions could push it out of that range? That's how serious currency analysis works. Daily rates give us the temperature of the market. They show whether conditions are calm, stressed, or shifting. But they don't tell the full story by themselves. To understand what this rate really means, you have to look at the system behind it, and that system depends on policy, liquidity, and confidence. One of the biggest misunderstandings in dinar discussions is assuming that stability automatically means strength. In Iraq's case, the exchange rate is not purely market-driven, the way it is for many major currencies. It's shaped by a managed framework, meaning institutions play a large role in keeping the rate from swinging too far in either direction. That's why you can see stability even when the economy faces real pressures. And it's also why you may still see differences between markets and channels. When official pricing and street-level pricing don't match perfectly, it tells you one thing clearly. The system is improving, but the transition isn't fully complete. This gap can come from several factors. How quickly dollars move through banking channels, import demand and settlement speed, market confidence and expectations, enforcement of financial controls and compliance. So when we talk about a stable rate, we should be precise. It may mean the central bank's tools are working. It may mean reserves are supporting the system. It may mean dollar supply is being controlled effectively. But it doesn't automatically mean the dinar is entering a new era of value. For the dinar to strengthen in a lasting way, stability has to be supported by deeper fundamentals, low inflation, credible banks, disciplined spending, and a functional financial system that reduces reliance on informal cash markets. That's why the next part of this story matters so much. What the central bank is doing inside the banking system, and how reforms are shaping liquidity and trust. To understand why the exchange rate has remained relatively stable, you have to look at what the Central Bank of Iraq has been prioritizing behind the scenes. At its core, the central bank's job is not to make the currency stronger overnight. Its job is to prevent instability, especially inflation and disorderly dollar demand. Iraq relies heavily on imports for everyday goods. That means inflation doesn't just affect statistics, it affects food prices, fuel costs, and household budgets almost immediately. Because of that, liquidity control has become one of the central bank's most important tools. When too much cash circulates in the economy, demand for dollars rises. Importers need dollars. Savers move toward dollars. And that pressure shows up quickly in the exchange rate. So instead of reacting to crises, the central bank has been focused on prevention. This includes managing how dinars enter the system, monitoring how dollars are supplied through official channels, and tightening oversight to reduce speculative or unnecessary demand for foreign currency. These are not dramatic actions, but they are effective ones. When liquidity is controlled, the exchange rate becomes easier to manage. When liquidity runs loose, no amount of intervention can hold stability for long. That's why monetary discipline matters more than announcements. It creates a buffer, a margin of safety, that allows the system to absorb shocks without breaking. And this focus on discipline also explains why banking reform has become inseparable from currency policy. Because without a functional banking system, liquidity control is impossible. While monetary discipline is essential, Iraq's economic strategy in 2026 is not focused on tightening alone. There is also a clear effort to support growth, but in a controlled and targeted way. Instead of broad cash injections, authorities have leaned toward directed lending programs aimed at specific sectors. These include housing, construction, and industrial activity, areas that generate employment and domestic demand without immediately driving inflation. This approach reflects a lesson learned from the past. Flooding the economy with unrestricted cash creates short-term relief, but long-term problems. Targeted lending, by contrast, allows growth to occur where it's needed most, while keeping overall liquidity under supervision. Another important element is the growing emphasis on small and micro enterprises. These businesses play a critical role in diversification, especially in an economy that has relied almost entirely on oil revenues for decades. By improving access to financing for smaller businesses, policymakers are trying to build a broader economic base, one that is less vulnerable to oil price swings and external shocks. This kind of stimulation does not produce immediate results. It works slowly, incrementally, but over time, it helps shift the economy away from dependency and toward resilience. And resilience, more than speed, is what supports currency stability in the long run. Politics remains one of the most important and most misunderstood factors influencing Iraq's economic outlook. Following the parliamentary elections at the end of 2025, Iraq entered another period of government formation built around coalition negotiations rather than clear majorities. This is not unusual for Iraq, and while it can appear slow from the outside, it also brings a certain level of continuity. In Iraq's system, no single group can easily impose drastic policy changes on its own. That limits sudden shifts, both positive and negative, and encourages compromise. From a currency perspective, this matters more than people often realize. Markets tend to react poorly to political shocks. Stability, even imperfect stability, is usually preferable to rapid change. Coalition-based governance reduces the risk of abrupt fiscal or monetary decisions that could destabilize the exchange rate. That doesn't mean political risk disappears. Negotiations can stall, priorities can conflict, and reform momentum can slow. But as long as political competition remains inside institutional boundaries, economic policy is more likely to remain predictable. For investors watching the dinar, predictability is not exciting, but it is valuable. Because currencies rarely fail due to slow politics. They fail when politics becomes chaotic. Iraq's economic path in 2026 is not shaped by domestic policy alone. External influence and regional dynamics continue to play an important role, sometimes quietly, sometimes directly. International partners, particularly Western governments and global financial institutions, remain closely engaged with Iraq's political and economic direction. This engagement is not purely symbolic. It carries expectations around transparency, financial compliance, and institutional reform. For Iraq, this external attention can be both supportive and restrictive. On one hand, international involvement helps reinforce discipline. It encourages adherence to banking standards, limits excessive monetary expansion, and supports credibility in the eyes of foreign investors. On the other hand, it reduces flexibility. Policy choices are increasingly scrutinized, and deviation from reform commitments can carry consequences, especially when it comes to access to financial systems and capital flows. At the same time, the broader regional environment is changing. Shifts in influence across the Middle East have altered internal political balances within Iraq. Some external pressures have weakened, while Iraq's ability to assert more independent policy choices has gradually increased. This evolving balance creates opportunity, but also responsibility. Greater autonomy means Iraq must demonstrate consistency and restraint. Currency stability, in this context, depends not only on internal reform, but on maintaining trust with external partners who continue to watch closely. Despite progress in several areas, fiscal risk remains one of the most important challenges Iraq faces in 2026. The core issue is concentration. Iraq's public finances are still overwhelmingly dependent on oil revenue. When prices are favorable, the system functions. When prices weaken, pressure builds quickly, not just on the budget, but on the currency itself. Economists have warned that if oil prices decline materially this year, Iraq could face a significant fiscal shortfall. This risk is not theoretical. It is a structural feature of the economy. The International Monetary Fund has been consistent in its assessment. Stability cannot be preserved through monetary policy alone. Fiscal discipline must play its role. Key recommendations remain unchanged. Expanding non-oil tax revenues, controlling the public wage bill, completing the restructuring of state-owned banks, and creating conditions for private sector growth. Without these measures, monetary stability becomes harder to sustain over time. For dinar watchers, this matters because currencies ultimately reflect fiscal reality. Central banks can manage liquidity, but they cannot permanently compensate for large and persistent budget imbalances. This is why fiscal reform is not just an economic issue, it is a currency issue. Alongside fiscal and monetary pressures, Iraq's long-term outlook depends heavily on infrastructure and investment. In recent years, foreign investment has gradually returned, particularly in the energy sector. Improved security conditions and clearer regulatory frameworks have made Iraq more accessible to international companies than it was a decade ago. Infrastructure development remains uneven, however. Electricity losses, aging grids, and water scarcity continue to weigh on productivity and public finances. These challenges affect everything from industrial output to food prices. International institutions continue to support Iraq's long-term development strategy, focusing on resilience, governance, and human capital. The emphasis is no longer just on rebuilding, it is on sustainability. For the currency, this matters in a very practical way. Strong infrastructure supports private sector growth. Private sector growth reduces reliance on government spending, and reduced reliance on government spending lowers fiscal pressure. This chain is slow, but it is critical. Without long-term investment in infrastructure and productivity, currency stability remains dependent on oil, and oil alone is not enough to guarantee durable strength. No discussion of the Iraqi dinar is complete without addressing the question that continues to surface year after year: revaluation. Speculation around a sudden, dramatic increase in the dinar's value remains common, particularly online. But it's important to separate hope from economic reality. The Central Bank of Iraq has been consistent in its messaging. There is no stated plan for a major, abrupt revaluation of the currency. And structurally, that position makes sense. Iraq's economy is still heavily dependent on oil revenue. The money supply remains large. And while reforms are progressing, the financial system is still in transition. Currencies do not strengthen simply because a country has resources. They strengthen when productivity increases, inflation is controlled, fiscal discipline is maintained, and confidence builds over time. That doesn't mean improvement is impossible. Gradual appreciation is always a possibility if reforms continue and stability holds. But sudden revaluation is not how modern currency systems evolve. For serious observers, understanding this distinction helps avoid disappointment and keeps expectations grounded in reality. As we look ahead through the rest of 2026, the picture facing the Iraqi dinar is neither bleak nor extraordinary. Oil production growth, banking reform, and international engagement provide support. Fiscal pressure, political complexity, and oil dependence limit upside potential. This is not a year defined by breakthroughs. It is a year defined by management. For dinar watchers, the most productive approach is not speculation, it is observation.